great future. We're talking real money.
Boy, oh boy, do we have a show for you today. Oh my gosh, it doesn't get better than today's program. I want to thank everyone who made this program possible. I want to thank the nearly inverted yield curve, and particularly I want to thank the stock market for all that it has done to make this week truly memorable. And in honor of that, we have invited the stock market to appear on the show. Mr. Stock Market, wow, Mr. Stock Market, you don't sound like you're feeling very well.
I felt
Is that
this
a cold?
poorly since I think it was 2015 or so, or was it 11?
Wow. Well, I'm just worried this might be the 2008 flu.
Oh no, that was full body aches and I was in bed for like a week. That's not this.
Oh, okay. So this is just like that cold you had in 2011. Then.
Yeah. It's kind of in the chest. It's working its way through my sinus. It's unpleasant, but it's not the end of the world. So.
If I remember though, you were down a lot more in 2011 and 2015. You're still doing interviews and all, so you must be feeling okay.
I have no idea if I'm coming out of this or I'm just the beginning, but it's just, it's unpleasant. Let's just put it that way.
I want to thank you for toughing it out.
What choice do I have, man?
Yeah, that's true. You're the stock market. And you know, it's funny, Mr. Stock Market.
Yes.
The media tends to love it when, you do so well so much of the time. I mean, I would guess 75% of the time you're up there, you're moving, you're making people money. And then every now and again you catch this malaise and the media loves you. What's with that?
Well, I mean, we do have, sort of higher expected returns than safer things, right?
Well, yeah, yet the safer things don't get this kind of press when they're down.
No. I mean, so we got people working constantly. We got agents out there that are getting media attention day and night. Mr. Dow and Standard & Poor's, they're always working.
But it occurs to me that maybe you should take a page from the president's playbook, and when they're taking you down, maybe you should be tweeting back.
I don't know. How does that work? I don't know. I got a phone.
You're a stock market. How do you don't know how to tweet?
No,
you don't have a clue. He's a clueless tweeter. Well, Mr. Stock Market, I want to thank you for just being what you are, because you mean so much to all of us on a day-to-day basis. You really are the thing that drives our financial future, despite these occasional ailments, and we wish you the best in the future.
We'll see if we can turn things around by the end of the year, Don. I appreciate all the attention you give us. I really do.
Vitamin C and NyQuil. Try those.
Okay, thank you.
Could be a lot of help.
Appreciate it.
Okay. We might have Mr. Stock Market back one of these days, but in the meantime, you're just stuck with me, Don McDonald, and that guy Tom Cock, who's over there hiding in the corner. And
had to get out of the way. That was scary. I'll tell you what.
Well,
he
was
contagious.
sick. You had to get out of the studio.
Yeah, that's not good. Not good at all. So
bad thing. Those stock diseases.
Yeah, short interview.
We are going to talk about what the stock market has done recently in the past week, the past month, and what it means, if anything at all. And we know that in times like this, we know this because we've been doing this a long time. In times like this, you freak out.
Sadly, many people do. Yes, they do. Yeah.
You freak out. You catch the disease that the stock market caught, and you get crazy, and you don't feel good. And so we want to help inoculate you. You know how you get a flu shot?
Oh, yeah. Yeah.
Don't you wish there was a cold shot?
I'm just sitting around waiting for Amazon to put one up there, and I'll have it shipped to my house.
I'm telling you, we have a worrying about the market shot for you to help you stop worrying about the stock market. And we know that it is difficult. Remember when you were a child and your mother would take you to the doctor, or your children, you take it, and the doctor would say, after you get your shots, I'll give you a nice lollipop. And you go, okay. We know you need help with your money. Yeah. And it's hard to call. It is. It's difficult. You go, I don't want to call those guys and say I did something stupid.
Mm-hmm.
Well, to encourage you to call us and admit to your stupidity. Or just, decisions. People do things and you make decisions you don't even realize you're making because you don't know enough.
Or defend your position that may be different than ours. That's always fun. It's the holiday season.
we will give you this shot no matter what your reason for calling, as long as you go on the air with us.
Tell Don he's wrong about Bitcoin. We're ready for those.
Oh, I wish. Come on. I am ready for you. Come on. Bring it on. Bring it on. 855-935-TALK is our phone number. That's 855-935-8255. And Johnny, tell them what they'll get.
Well, I tell you what, you're really feeling gracious about the holiday here.
It's the holiday season.
So, pretty good. So, if you call, and you had to be on the air, right?
Yeah,
there's no calling and then hanging up. So, Kelly's very kindly.
We wouldn't know who they were anyway if they called in.
Yeah, no tricks. Kelly's going to very kindly take your name and your telephone
and your number.
And then we're going to call you back and get your address and send you a free copy of Financial Physics.
You and sound effects.
Financial Physics, the wonder book that will tell you every single thing you need to know about investing.
And not the 2010 edition.
No,
the 2018 edition of Financial Physics, all updated with new numbers and new everything.
By the way, my reviews are coming in. Good one, Mr. Stick Market. Somebody wrote me.
Stick Market. 855-935-TALK, the number.
Are talking real money.
Just as there are basic laws that govern our physical world called physics with a PH, there are also basic rules and concepts that impact our finances and investments. I call them financial physics with an F. In fact, 8 years ago, I wrote a book about them. For years, I've wanted to create an interactive version of that book to help readers better understand the concepts. So, since it was time for an update, I turned Financial Physics, with an F, into a special interactive multimedia version only on iBooks. It's the only platform that allows that. Because I want everyone to have access to this information, I decided to give this version away. Yes, it's totally free. So if you have a compatible Apple device, go get your copy of the new interactive book, Financial Physics, on iBooks. It's totally free, and it's available right now in the iBooks store.
For your real life and real future, Tom and Don are talking real money.
And get your bad market vaccination today. We promise it won't hurt a bit by calling us at 855-935-TALK, 855-935-8255. And after you get your inoculation, you're going to get a lovely lollipop. Well, no, wait, a book, a copy of Financial Physics, the book that's even better than a lollipop because it doesn't put on any fat at all.
And it lasts longer.
Lasts longer
and does not have a wrapper on it. Well, yeah, don't lick it.
Don't lick it. No. I can't vouch for the substances they use to varnish the cover. I don't know what's in those.
Good point. And
855-TALK. 855-935-TALK.
855-935-8255 for those of you who are like me, challenged
by words.
The talk thing.
Challenged by words.
Yeah, but the numbers.
I am, much like our president, challenged by words, according to Rex Tillerson.
The numbers, though, this year the S&P 500 is down 8.5% from its January high. By the way, it's about broken even on the year.
For the year. Yes. It's really close to flat. A little low, but yeah.
And if you bought a portfolio that has 60% global stocks, 40% bonds, you're down about 5% year to date.
Now, why would that be when the S&P 500 is not down? It's not down much, like 1%.
Call back Mr. Stock Market, but he left. He got hospitalized, I think. But
don't say that. That would be like 2008.
That's a good point. So, because things that aren't large U.S. stocks have had a pretty tough year. International small companies down over 16. Emerging markets, those places that look a little risky from time to time, but making more. Emerging markets, they're down 13.7. Small companies here in the U.S. down 6.9. But my friend, real estate investment trusts are still making. All right,
but I would like to, because here's the problem: people get and you just helped perpetuate this.
Yeah.
I blame you. People get caught up in those short-term numbers.
Yeah. Right.
Now, because, folks will say, well, then, if the S&P 500 didn't go down as much, why would I invest globally when I could have just invested in the S&P 500? Did you forget the 2000s? from 2000 to 2010? Did you forget what happened then? What did the S&P 500 do between 2000 and the end of 2009, Tom?
Not broke even.
Actually, it was down 1% per year on average. It lost money 1% per year on average over that 10-year period. However, that 60-40 global portfolio that you just mentioned.
So you add in a lot of stocks outside of the United States. You do away with the home bias of just owning our country. Yes.
But what did that portfolio do over that same 10-year period?
I'm gonna have to
I
go
know I
find
gave
that.
you the number.
I know you did.
I know it by heart. 6.2%.
It says 6.3 on the thing you sent me.
6.3. I was close. 6.3. 6.29.
I want my 1/10 back. That's annualized.
That's per year.
Yeah. So that's quite a
with
difference
less,
in losing.
less volatility.
Right, yes, much less. Can't promise that every period of time, but that in that period.
But long term, I mean, over decades, that has worked out.
It has.
Over decades, that's globally diversified portfolio has given you returns that are pretty darn close to the stock market, a little above, a little below, but really close, without owning 100% stocks, which is risky, and with a lot less volatility. 855-935-TALK's our number. And Harvey, you're on. Welcome to Talking Real Money, and please roll up your sleeve.
Yes, I just wanted I had a problem with my SEP account here, I guess.
Yes, a SEP IRA.
SEP IRA, yeah. Mm-hmm. And it's in a bank, and it's getting ready to roll over into the new. I'm in my grace period, and it's going to roll over to a new term, but it's going to be too long. I'm getting too old, so. I'm 69 now, and I guess on those IRAs you're supposed to start withdrawing at 70 and a half.
That's correct. Required minimum distribution.
But it's only a start, Harvey. You don't have to take it all out at 70 and a half. And is your SEP IRA one of many retirement plans? Do you have other IRAs? Do you have 401ks or anything else?
No.
Just this one SEP IRA?
Yeah, this one SEP IRA.
How much money's in that SEP IRA?
Yeah, very little money, maybe $20,000.
Okay, you don't have to take it all out when you turn 70 and a half.
The amount you're going to need to withdraw at 70 and a half is going to be relatively small. It's about 3.2%, I believe, the first year.
Yeah, but my problem is that this rollover is going to be a year and a half, automatic rollover.
Well, then take out your required minimum distribution in the year you turn 70 and a half. You don't have wait a minute. You're how old now?
69. I mean, why don't you just take the whole thing, roll it into Vanguard's balanced fund, and leave it there?
No. Wait. He's in a CD now.
Oh, okay. But I thought it said that it was expiring.
Right, but you're
no. So see, I'm in the grace period right now. Okay.
I know, but Tom, taking somebody from a CD into a balanced fund.
I understand.
Without telling them what a balanced fund might do to them.
Yes, I understand that part of it, but I don't know that having your entire retirement savings in just a CD, unless you need the money in the next few years, is a good approach either.
Let me do this. Let me come back full circle. Why is it in a CD? Is it because you wanted absolute safety or because it was just easier?
It was just a forgetful thought. It's an old dinosaur. I don't think you can get a SEP IRA anymore.
I think you could still open a SEP IRA.
Yeah, but that's not the point is, the question, though, is why did you put it in the bank as opposed to, say, going to a mutual fund or a stockbroker or Vanguard?
It was because when I was working for this employer, that's what it started out as. So I just left it as.
All right, then Tom may very well be right. Can you? Let's just say for a second, you take your $20,000 and you go over to Vanguard and you put it in. Let's use a more diversified fund. Let's use like the Star Fund.
Yeah,
which has lots of stuff in it. You put it in this fund. It has a little bit of stock. It has a lot of bonds. It has all these different things in it, or Vanguard Balanced Index, or whatever it might be. You put that in there, and a year from now, you're going to go in and withdraw enough for your required minimum distribution, and the $20,000 is now worth $17,000 because the stock market declined. How do you feel?
Money doesn't really matter. I wouldn't like losing it though, but
Nobody likes you losing it, but can you stand it? Can you tolerate it?
Well, it's kind of weird that you're safe. You have money that's been safe, and then whatever. But I was just wondering if I guess what the question was trying to deal. Can do the banks? I guess banks aren't your fiduciary, really. They just want to make money. So, but there's no way.
Here's what I would, given what you've said, and I've heard, the fact that you haven't done this before, I would consider going to Vanguard, but I got to tell you, I would get something like their bond index fund, which isn't going to have extraordinary volatility. It's going to be very mild. It'll pay you probably a little bit more than the bank, not a lot, and you'll be able to withdraw what you can what you need whenever you want.
Tom and Don are talking real money.
You've heard that about 99% of all financial advisors are not always required to act in your best interest. You've probably been pitched financial products by all manner of friends and relatives, and the investing you have done is probably a hodgepodge of ill-fitting pieces that are doing little to provide the financial security you need. If you're looking for a 100% pure fiduciary, and we'll put that in writing, low-cost, fee-only advisor who always puts you first, give Vestory a call at 800-386-3004. That's 800-386-3004, or visit us online at Vestory, VESTORY.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey, Tom, I have a question for you.
Yes.
What was the biggest declining stock yesterday?
Wow. The largest decline on a percentage basis?
The biggest percentage decline.
I'm going to go with one of the FANGs, like Amazon, Microsoft, Apple. No.
This is a stock that almost every woman will know, but you probably don't, unless your wife has dragged you in.
I'm not a shopper, as you know.
It's a store called Ulta.
I know the name, but that's all I know about it. Yeah.
ULTA. Ulta was down 13.3% yesterday. Wow. I'm using that as an illustration of how much one stock can beat you up in a day. And it's like one of those things that you ask a young woman, hey, pick the best stock, and they might go Ulta, because I go there all the time.
Yeah, great store. Sure.
Down 13.3% in one day. Now, a couple of weeks ago, Ulta did tie up with one of the Kardashians, Kylie Jenner, who's got a new makeup line there. Oh. And, it could be coincidence, tie up with the Kardashians.
I'm not going to say anything there. I'll let you handle that one.
855-935-TALK is our number, 855-935-8255. And, hey, Renee, how's your day?
It's going great.
Good.
Thank you.
Our pleasure. How can we help you today?
Well, for your previous caller, I, too, had an IRA that was a CD, and I put it in a regular IRA account at the same bank. So that may be another option for your previous caller. But my question, I'm a little younger than your previous callers, but 70 and a half is coming up quickly. And I'm thinking, I'm a married couple. I file married filing jointly. I'm thinking that if I start pulling out some of that IRA income, I'll have a lot less that I'm required to pull out later. And we've got that double 12,000 standard deduction this year.
Yep.
And if you're over 65, you get an extra $1,250 on top of that. So I'm thinking if I start pulling out money, I would benefit from doing so. What do you think?
Well, there's a lot of reasons to be careful about your taxes in retirement, was what you're really talking about. Because people, first of all, if you don't need the money and taxes are not an issue, then letting it grow and taking it out at 70.5 is a good philosophy. If taxes are important, if you're trying to figure out how to reduce your taxes, leveling out those required minimum distributions over time, you're right, would probably reduce your taxes. By the way, there's reasons to own. You might want to just switch what you own in that IRA to be the safer stuff. And if you had other money, put that in the stocks, because then the IRA doesn't grow as much and you don't haul as much out.
Another thing you need to bear in mind is weighing your current tax situation against your likely future tax situation. Are you fully retired, or are you still working? Or is one of you still working, or both of you?
When my spouse is working, I'm retired.
Okay. Here's the problem with taking it now then. By adding that money into his income currently, you stand the chance of ratcheting up. You're going to pay extra taxes, and you might ratchet up your bracket. By waiting until 70 and a half, even though you're going to get hit with a bigger withdrawal at that time, because he and you are both not working, you're likely to be in a lower overall bracket, still enjoying that same standard deduction, but at a lower bracket.
He's going to be working like another 5 or 6 years. He's a lot younger.
When do you reach 70 and a half? Roughly. You can ballpark it for me.
Yeah, we don't.
Nobody knows who you are. It's okay. 4 years?
I guess.
Okay.
I got to tell you, my first inclination, without sitting down, where you probably should sit down with your tax advisor, but my first inclination is to say, I wouldn't. Generally speaking, it's better to let it ride, tax deferred, than to take the hit, particularly when in 5 or 6 years even, you are going to be in a much lower bracket, and those initial distributions are so tiny.
Yep.
They're just almost non-existent. Now, the thing you might want to reconsider is having an IRA at the bank. That may be costing you a fortune.
Tom and Don are talking real money.
Keeping the podcast breaks as painless as possible is my goal. That's why I want to very quickly tell you about the only magazine I've ever heard of that is 100% real investing all the time. There's no business news, no speculative advice, and certainly no lifestyle stuff. It's called Real Investing Journal. I publish it every quarter, and you can get 2 full years for only $25 at realinvestingjournal.com. That's realinvestingjournal.com.
Reality radio for a really great future. We're talking real money.
Hi there, folks. Welcome back to the program. It's called Talking Real Money, and it's called that because we talk about real money issues that really impact your day-to-day life, and wow, do they hugely impact your future. Because if you haven't figured it out yet, you're eventually going to realize, and I hope sooner than later, that you're going to need a lot of money once you get to the point where you cannot work all the time or work at all. They call that retirement in most of the world. Mm-hmm. And Social Security ain't going to cut it. Because Social Security is about the average is about $1,400 a month.
Still, half of the country takes Social Security at age 62.
Which is really awful.
Yeah, it really is.
Because at 62, it is a tiny fraction of what. As a matter of fact,
even at full retirement age.
I looked at mine, and my I could take the early now, but I get twice as much if I wait until I'm 70.
It's absolutely, it's imperative if you expect to live into your late 70s. I mean, it really is, but
twice as much.
People just wake up and say, I'll just go get my benefit now because I'd like to get the money. So they don't think it through. It's just it's easy, and it's less volatile than the stock market. Let's put it that way.
Unless you're pretty darn sure you're not going to make it past 70, then
I said that the other night in the class. Like if everybody in your family drops dead at 70, then absolutely. Or if you have health problems, absolutely. Or if there really is no other way, then you got to take it. I get that.
Okay, hold on a second.
Yeah.
Yeah, Mr. Stock Market. Yeah, you're right. You probably should take Social Security early.
He is
bad
not.
As you're feeling. Yeah.
He's had a tough decade. I gotta say, he should be.
He's had a tough year this year.
Tough year.
I'm sorry. Yeah, no. Okay, you're stock, but you could still take NyQuil.
Take stock in it. Yeah.
Take stock in NyQuil.
No, so I mean, that's a tragic error. It's only 3% of Americans who wait until age 70. 3%.
That's all.
3%. I mean, the reality is for most people, by the way you're listening, you probably got to work to between 65 and 70, depending on the
Apparently not enough people listen to us, or we don't say it often enough.
No, we don't. I don't think we do, because I think people...
What is the average annual increase? I think I read somewhere it's like
8% a year.
8% per
plus
year.
inflation. Remember, so every year you get the COLA. Next year it's 2% more on top of that.
So that's like 10%.
Indeed it is. And is there anything else you know that makes you that much regularly over the years?
I don't know of much of anything that gives you even an inflation adjustment for sure.
Other than equity index annuities? I mean, that's pretty much the only place I know.
Even they don't give you an inflation adjuster.
Oh, come on, really?
No, you gotta pay extra for that. You gotta give up more. Oh, you're going to get me started on equity index annuities, aren't you?
It's a holiday, baby. I'm trying to get you revved up. By the way, program note, you will be on your own doing this next week and the 27th or something like that. So,
29th, I think.
So people really want to talk to the Grinch. Here's your opportunity.
No, this is our opportunity to just do things that Tom would never let us do.
That's a good point. I might be listening, by the way. But I will not be
against
here.
it.
Okay.
And you'll be where? In Hawaii? What are you going to do? Fly from Hawaii over and beat me up? You're not leaving that beach. You are not leaving that beach. 855-935-TALK is our number. 855-935-8255. It's Inoculation Saturday, and to make it hurt a lot less make the call hurt a lot less, because we know it's painful sometimes to call and talk about money. You're not supposed to talk about money in mixed company, that kind of thing.
Polite circles.
Polite company, yeah. So to make it easier, we're going to give you a copy of Financial Physics just for calling and being on the show.
That's it.
855-935-TALK. And Tom, it is now your time. Welcome to Talking Real Money.
Tom, this is Tom.
Hello?
Tim, my bad.
Hey, you wrote Tom.
Yeah,
I know. I don't want to make you feel bad.
How you doing?
Good. How are you, sir?
Good. I've got a quick question. And as I'm very close to retirement age, I'm about 16 and a half, and I can retire with 30 years in about a year and a half. But my question is, you guys are talking about, we should all wait till we're 70 before we pull our Social Security, given that we have decent health and whatever, My question is, if I draw at 62, if I draw at 63, which is going to be my retirement where I've got 30 years in, if I draw at 63, I make a certain amount of money. But if I draw at 62, I make a lesser amount of money.
It changes every month, by the way. Yeah.
Okay, so so if I draw at 62 as opposed to 63, I'm going to get 12 months at this lower amount. And then in 62, I'm going to continue to draw that lower amount, but I'm going to have that pot of money for a year, okay? If I start drawing at 63, a higher amount, but I have to make up for that pot of money.
No, I understand what you're saying.
Yep. 62.
You got to live to about 79 to get the lines to cross to work. So again, that's why we were saying if your life expectancy, most people, by the way, are living longer than they expected. Most people end up needing more money than they expected. So you're correct. You could take that money, spend it, and you would be waiting for the other money till 70. It turns out, though, that the numbers cross. And, by the way, if you have a spouse that's younger than you, then it really, because she inherits your benefit.
Yeah, because she gets a half of your benefit at that greater amount when you turn 70. So that can make a really big difference to her.
Tom and Don are talking real money.
I just recently created a new and massively improved interactive edition of Financial Physics on iBooks, but I don't want to leave out those without an Apple device, although no other platform offers their interactivity. I have, however, created a free static PDF version of Financial Physics with an F that you can get right now at TalkingRealMoney.com. That's TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
I just did some rough calculation during the break. By the way, the number is 855-935-TALK. I looked at my Social Security at 62.
Yeah.
And just did some rough calculations at 5%, at a 5% return on the money invested.
You take the money, you get the money from Social Security.
I get it today.
Put it in an account.
Right, until I turn 70 until I turn 70 and a half.
Yep.
Until I turn 70.
And you put 5%
and I put it in an
a
account
year.
and it grows, 5% a year.
Okay.
And then I start taking it out at 70 to add to my now lower Social Security because I'm at the lower benefit.
Yep.
I'm just talking about me, not my wife. My wife would get half of my Social Security now and then get the whole benefit, but my reduced benefit now, the smaller one, not the big one.
She only gets the big one.
Right, but I mean the 62 benefit that I took, not the 70 benefit.
No, she would get the lower benefit. That's what I was saying.
I got out to 90, and I still didn't break even.
Yeah, and the way you and I have lived, I think 90 is a long shot, my friend. I'm just saying. I've been around long enough to know. So
it's better. In my case, it is better, a lot better for me to wait till 70.
It's kind of a miracle you're still alive after Lake Chelan last year. I mean, frankly, pulling you out then was a tough one.
If you hadn't dunked me.
I still feel bad about that. At least your cell phone made it back to the boat.
Made it back to the beach and then to the Apple store where it got traded in for a new one. 855-935-TALK is our phone number, 855-935-8255 on a terrible, bad weekend. It's an awful, awful weekend.
What's wrong with the weekend?
The week.
Oh, because stocks lost money?
Oh yeah,
Lord.
It was so depressing.
You need to find other interests because that's silly. But I just wanted to add in on the Social Security part of all this because most people don't give it the attention it deserves, and most people need professional advice on this. I know it sounds promotional. Give us a call Monday, we'll fix you right up. But
yeah, it does.
It does, but it's such a big decision. It's so humongous. And once you check that box, yes, you can give the money back, I think, for a year or something, but after that, you're in, and that's it. That's what you're going to get the rest of your life. It's very large decision. So
it's a very large decision, and you really need to consider all of these financial decisions very, very carefully. And one of the reasons why we say you need help, and again, we don't say that our firm, Vestory, is the only source of that help.
No.
We have never said it. We never will say it. But we will tell you that Vestory is one of a very elite group, a very small group of wealth advisors, investment advisors, financial advisors, everybody calls themselves
Counselor,
that.
yeah.
A very, very, very elite group of advisors who hold themselves to the highest of high standards, and that is always acting in your best interest. There's a big difference between all the guys all over the place. You go to the brokers now, and they're all going, "Oh yeah. I act as a fiduciary. Yeah, I'm one of them there fiduciaries." Except
not
for
this
when
part
I
of
don't,
the country, but okay.
when I don't have to be. They moved to Seattle from wherever I was,
Jersey or New York or whatever it was.
Yeah,
Okay,
I was I was a slime ball, and now I am no longer.
Yeah, and the problem is they're not.
I have
all
given
the
up
time,
slime
right?
ballery.
Yeah, slime ballery. Well, and the problem is they could be a fiduciary sometimes, and then they can only do they can do what's suitable for you other times. So it's a bit tricky.
Thus, my invention of the hat trick.
Oh, the hat
trick.
How are those hats going? Are they flying off the shelves?
We've sold all of one pair.
I would like to know who bought the pair. We should go visit.
Think I was just thinking this. This is why I'm mentioning the hat, because it is the holiday season.
You're going to give some hats away now, too?
What better gift?
Give the gift of
you got to
hats?
buy the darn thing.
Oh, okay.
What better gift to give someone who has a stockbroker who is lying to your friend or relative's face and telling them they're a fiduciary, when in fact they're only a fiduciary for like 12 seconds, and then they sell them a loaded mutual fund or an equity indexed annuity, which we're going to get to again later. Get them the hats.
By the way, they can do that because they're a thing called duly registered.
Yeah.
Registered as a registered investment advisor and a broker-dealer.
You can be both honest and a liar at the same time.
It's not easy, but it is done. So, okay.
Pinocchio pulled it off. Pinocchio pulled it off.
I'm going to let you finance your holiday season. All right, how do they buy the hats?
The money goes, I don't know. We'll send it to a charity or something.
Where do they get? Where are the hats? Because there's
Talking
still time
real
to order.
Money.
Oh, okay.
Yeah, they could order them. They're right here. I got them just in the next room.
Box of them just sitting around
I got
there?
a box of hats. I got some boxes to pack them in. Nice gift boxes.
All right. They can do the hat trick.
But here's the deal. You see, what this does, this is like, you ever watch Harry Potter? The Harry Potter movies?
No, I read the books.
This is like the sorting hats.
Yeah, well, okay, I know
These
what
are
that
the
is.
sorting hats.
That's a good point.
These sort the fiduciary from the merely suitable advisor.
And what?
Because
I forget
they say
the colors
on it,
now.
The green hat says fiduciary.
Yeah.
I think, no, actually it says in your best interests on the hat.
Yeah.
And then the red hat says merely suitable.
And all this time, I thought the red hat said "Make America Great Again." I guess I had that wrong.
Or I thought of another purpose for them.
Yeah.
You could use them on blind dates. What you could do is on the blind date, you could have them in your purse or your bag. And when you're out with the person, you can go, I have decided.
This is really a bad idea.
I have decided that you are merely suitable.
This is no.
Or you're in my best interests.
Wow, yeah, okay. That's maybe for speed dating or something, but I wouldn't suggest it like when you're out together or something. Anyway,
you don't think so? I thought I had a new use for them.
My sense is
it's called repurposing.
I don't think we should be giving people advice on dating. Money, maybe, dating, not so much.
No, I'm letting them make the decision.
I know, but
is that person across the table from you merely suitable, or are they in your best interest? Get the dating hats at TalkingRealMoney.com.
Okay.
TalkingRealMoney.com.
Now available at a special holiday price. Which is what?
Same as the regular price.
I know, but you say that anyway because it promotes it more, right? People are like, I got to get that special holiday price.
I hadn't planned for this moment.
I know.
So
well, this is just, coming up real quick here.
This was ad lib.
Exactly.
We scroll down the... Oh, my gosh, did I take them off the page?
You don't have Ricky's picture there anymore with the hats?
Uh-oh. I better put those back up.
You better, because now the demand is going to go skyrocketing high.
Through the roof.
I was going to get one of those Star Wars. I was going to get a Star Wars coat, but now I'm going to turn around and get the hat instead. So,
all right, you talk for a minute. I'm going to put them back on the web.
You're really going to put those back up there?
I'm doing it right now.
All right. Okay.
I have web powers. We're going to take a break in a minute anyway. You can't wait a minute. You cannot buck and wing for 1 minute.
Probably not. It was a long couple of days. I had to go see my business partner. That's not easy. It takes a lot out of a guy.
From my perspective as a host, this is one of our funnier shows.
I can give the phone number.
Which probably, you know what that means? Do you know what that means? The last 2 times we've had, like over the year, we've had the funniest shows we've ever done. The tape recorder didn't work at Como.
So then we said, that's too bad. By the way, that's what I say about my TV show. The tape recorder didn't work for the good shows. It's just the bad shows, sure, no problem. I will say this, then, while you're working on the hat trick, you can call at the top of the hour, 855-935-8255. And if you ask us a question, we will give you a free copy, all wrapped up for the holidays, of Financial Physics, the updated Financial Physics. 855-935-TALK.
They're called Advocaps, and they're $33, and I'll have them on the web by the top of the hour.
That's expensive.
$33 for the pair.
For a ball
it's 2 hats for $33.
Okay.
2.
Sounds like a lot.
Wait, they're embroidered.
That's why, I guess.
They're embroidered. They're extra special.
Tom and Don are talking real money.
Your number one financial goal must be retirement. As we live longer, our need for a substantial retirement nest egg has grown. That's why you must have a plan. And to help you map your route to a brighter future, I created Vestory's Better Retirement Guidebook. And you can get a free PDF copy right now at retirebetterbook.com. It's truly free and there is no obligation. So get your Better Retirement Guidebook now at retirebetterbook.com. retirebetterbook.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Oh, yeah, and one other thing that's a really, really great gift that you could give someone this holiday season, tickets to Retire Meet. We've got our 5th annual Retire Meet coming up, and it is the biggest, best one ever. We've got some incredible speakers, because this is Retire Meet 5, or Retire Meet V for Victory or Vestory, and it's going to take place at the Maidenbower in February, and you get your tickets right now, discounted tickets at TalkingRealMoney.com, TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.